examples already. We did the direct financing, we did the sales type, we did the bargain purchase option. And is that the last one we did, is bargain purchase option? Mm-hmm. Yes. And so remind me, did I talk about residual values last time? So I didn't go through this stuff.
You started doing your last.
But so I guess I don't remember. All right, we'll do a quick review. Residual value. So if at the end of the lease term, the asset is going to have some kind of value. In other words, if you're not using up all of the asset by the end, which in that case, the lease term and the length of time that the asset is going to be useful is going to be equal. If that's not true, then you're going to have some residual value. Now there's two possible things that can happen with that residual value. You can have a guaranteed residual value, which is when the lessee guarantees the value of the asset will stay at a certain amount to the end. And that gives them incentive to make sure that they don't break it and they maintain it correctly, because they're going to be responsible to pay that amount if the asset is not worth that amount at the end. So let's say, for example, that they guarantee the asset is going to be worth $2,000 at the end. Get to the end, it's only worth $1,000. Then the lessee would have to give them the asset back, which is worth $1,000, and then pay an additional $1,000 to make up the difference. Alternatively, if they get to the end and it's now, instead of being worth $2,000, it's worth $4,000, they give it back, that's it. They give back the asset, that's all they had to do. So they don't get anything back if it's still worth more than the amount that they promised. It's only if it goes below do they have to make up the difference. Does that make sense? So that's a guaranteed residual value. Guaranteed residual value is essentially treated very similar to a bargain purchase option. And a bargain purchase option is treated basically as an additional payment. And so a guaranteed residual value is treated very similarly, like this is basically a payment. Either we have to give them back an asset that's worth $2,000, sort of like a payment, or we have to give them cash of $2,000. One way or the other, we're giving them something worth $2,000. And basically we treat that like a payment of $2,000 at the end of the lease term. An unguaranteed residual value, a lease agreement may be silent as to the question of the residual value. This is referred to as an unguaranteed residual value. In the case of an unguaranteed residual value, the lessee is not obligated to make any payments other than the periodic rental payments, and then whatever it's worth, they just give the asset back at the end, it doesn't matter. If it's worth $10,000 or zero, who cares? You give it back, done. Don't do anything else. So, here is how we account for it. A lessee guaranteed residual value is included as a component of the minimum lease payments for both the lessor and the lessee. So, if it's guaranteed, it's basically another lease payment, just like the bargain purchase option. An unguaranteed residual value is not, so we ignore whatever that value is going to be, at least with regard to the minimum lease payments. Now there will be something that affects the lessor, and we will deal with that as we get there. If the lessee obtains title, the lessor's computation of the lease payment is unaffected by any residual value, so we don't care. So if it changes hands, who cares what it's worth? They just get it, great. If the lessor retains title, the amount recovered for the periodic lease payments is reduced by the present value of the residual amount, and that's the part we will deal with. On the other side of the transaction, the lessee considers the purchase price of the asset to include the minimum lease payments and this additional payment, which we've already talked about. Let's do an example. And we're going to start with the guaranteed residual value, and we'll do the unguaranteed residual value after. So in this example, January 1st, Guyman Inc. leased a stump grinder once again from Blunt Corporation at a price of $10,000. The lease agreement specifies annual payments beginning January 1st and then every December 31st through 2015. The estimated useful life of the grinder is 7 years. At the end of the 6-year lease term, and I'm pretty sure this is right, 6-year lease term. We didn't mess up these dates. 6-year lease term. The grinder is expected to be worth $2,000. The residual value of the grinder is guaranteed by Guyman Inc. So in other words, they're saying we're going to maintain this such that it will be worth at least $2,000 by the time we're done with it at the end of 6 years. So when we get this thing back, it'll be worth $2,000. If it's not, we'll make up the difference. Blunt manufactured the grinder at a cost of $8,000, and its interest rate for financing the transaction is 8%. All right, so first of all, is this going to be an operating lease or a capital lease? Alright, so tell me the reasons why it's a capital lease. Okay, so there's one that should be really obvious.
The manufactured. Because it was manufactured.
Nope, that doesn't affect this decision.
The transfer of ownership.
It's more than
At least,
75%.
Okay, so the lease term is,
6
what is it now?
years.
6 out of 7, which is more than 75% of the useful life, therefore it has to be a capital lease. The other one is going to be the present value of the minimum lease payments, and we'll look at that and you'll see that that's also going to be about 90%. So this is going to be a capital lease. And this is going to be a sales type or a direct financing. Okay, now answer the way you asked. Because it was manufactured and there's going to be a profit going from 2,000, sorry, not that one, where's the number? Cost of $8,000
Price of 10.
and they're leasing it for $10,000. So there's going to be a profit of $2,000. So it's going to be a sales type capital lease for the lessor. Alright, so the first thing the lessor needs to do is they need to figure out what the payments are going to be. So very similar to a bargain purchase option. We don't know the payments yet because we have to figure it out. And there's going to be a total of 6 of them. We have the beginning and then 5 more. And the lease term goes to the end of that period. At the end of that period, the lessee has to either return an asset worth $2,000 or give up cash of $2,000. So essentially we're going to pretend like there's a payment of $2,000 that happens right here. So this should look very similar to the bargain purchase option. Does it look similar to you? Okay, so this is essentially the same thing we did with the bargain purchase option. Now we take the present value of the $2,000. So present value is going to be 1, 2, 3, 4, 5, 6 periods we're bringing it back. And the market rate of interest is 8%. And so we're going to take $2,000 and we're going to multiply that by 0.63017. And that is going to give us a present value of 1260. So that $2,000 brought back to today is worth $1,260 in today's terms. You okay with that? All right. So of the $10,000 price, that is the lease price today, $1,260 is from the $2,000 of assets they're going to get back. And so we're going to take the $10,000 and we're going to subtract the $1,260. And that is going to give us $8,740. So, and occasionally students have had this issue, and they just want to take the $10,000 and subtract the $2,000, because they're basically saying, okay, it's worth $10,000, we're going to get $2,000 back, so $8,000 is really the amount that we are getting from this. What's the problem with that?
It's not fair value.
Right, this $2,000 is not worth $2,000 today. It's only worth $1,260. And this $10,000 is in today's terms, so you can only compare things in today's terms with other things that are in today's terms. Otherwise, you're talking about apples and oranges, and you cannot add or subtract those things. So, $8,740 is the present value of all of these X's, all of the other payments except the $2,000 which we've already accounted for. So now we'll do the present value of an annuity due. It's going to be 6 periods, 8%. And the present value is going to be $8,740, which is going to equal the payments times the factor with that information. Present value of annuity due, 6 periods, 8%, which is going to be 4.99271. Solve for X, and you get 1,751. So 1,751 has to be the cash payments, the 6 cash payments. One today, one at the end of this year, one at the end of next year, 6 of them total. Questions so far? So the calculations are identical to what we did with bargain purchase option. The journal entries will look slightly different, but the calculations are identical. Now, let's figure out the calculation of the present value of the minimum lease payment for the lessee. They're going to say, all right, the lessor says we have to make payments of $1,751 here, 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 here. And then we either have to return an asset worth $2,000 or give them $2,000 of cash, one or the other, or a combination of the two. And so we say, all right, present value of these payments is going to be 1,751 times 4, 9927 equals 8740. And then they're going to say, all right, and then the $2,000 payment gets the present value of guaranteed, all right, I spell guaranteed, Guaranteed value is going to be 1260. The total is going to be the present value of the lease payments, which incidentally is the amount that must go on the lessee's balance sheet when they record it initially. So that's why they're figuring out this number, because they need that to figure out the journal entries on this initial date. So record the asset and the liability on 1/1/11. We'll do it from the lessee's perspective. They just figured out this number right here, so they're going to debit leased equipment for the 10,000 they just figured out, and they're going to have a lease payable for the same amount. The lessor is going to, it's a sales type one, so we're going to have a lease receivable of the same amount, $10,000. We're going to have sales revenue of $10,000. We are going to have a cost of goods sold of the amount that they manufactured for, which is $8,000, and then their inventory can be reduced by $8,000. Any concerns? Questions? Rude remarks?
What's the point of figuring out, since we know, doing the computation for the lessee?
It is, so the purpose of me putting that there is to try to describe, so if I just gave you a problem just from the lessee's perspective, this is what you'd have to be doing.
Okay.
In other words, if I just gave you the cash flows, and I said, all right, give me the journal entries for the lessee, this is what you'd have to do. Present value of all the payments, and then get this amount, and then there's your journal entry.
Come up with the 10,000.
Yeah, this is just to demonstrate that this is what they're doing. But you're right, in this problem, I'm kind of doing something then undoing it, but this is, from their perspective, what they would be doing. Does that seem reasonable?
Mm-hmm.
Okay. All right, same date, so all this is the same date so far. So this is the journal entries for the asset and the liability. This is the first payment, happens on the same dates, this X right here, which is going to be 1,751 in cash. And so for the lessee, they're going to reduce their lease payable by 1,751. Cash is going to go out, 1,751. Why no interest expense? No time has passed, it's the first day. You're exactly right. From the lessor's perspective, they're going to receive cash of 1,751. They are going to reduce their lease receivable by 1,751. That's all they have to record on that day. All right, so now 12 months pass. December 31st. So just like on the exam, we don't have December 31st and January 1st. The second payment happens December 31st. Just makes life easier, so everything's going to happen on the same day. So on this day, we have to deal with a couple things. There's a payment that's going to happen. There's interest expense and interest revenue that we have to record. And someone has to record depreciation. Okay? So that we're going to deal with all of those things. So from the lessee's perspective, let's go ahead and record the interest first. So let's figure out the amount of interest that they're going to have. So we need to figure out the carrying value. And so our carrying value is now going to be the 10,000 minus the 1,751, which is going to be some number, which I can't find on my paper. Oh, here it is. So 10,000 minus the 1,751, which equals to 8,249. Then we're going to multiply that by the market rate of interest, which was given to us at 8%, and that is going to give us interest expense of 660, or interest revenue if we're the opposite person. So for the lessee, interest expense of 660, and so we're going to debit interest expense 660. We're going to make a cash payment of 1,751, and the difference goes to reduce the lease payable, which is going to be 1,091. So does the lessee record depreciation?
Yes.
What do you think?
Yes.
Yes. Very good. I was waiting for other people to agree with you.
Yes.
Yes. So the lessee is the one that's going to record the depreciation. Why? Because they have the asset on their books. Therefore, they have to record the depreciation. All right. So let's go ahead and do the depreciation for them as well. Down here, the total value that they originally put the asset onto their books, and it's still on their books for, is the $10,000. All right. So let's think, just for a second, from the perspective of the lessee. They just put $10,000 as an asset onto their books. What is the residual value of the asset? The expected residual is $2,000. Okay? So, just like when we're using straight line depreciation, we're going to take the carrying amount minus the expected residual value, which is expected to be $2,000. We're going to subtract the $2,000. And then that difference we're going to divide by the lease term or the total useful life of the asset.
Lease term.
Lease term. Why? No bargain purchase option, no transfer of ownership. Okay, so our lease term, which is, remind me how many years? Is it 6?
Yeah.
So we divide 8,000 by 6. Does everyone see why I subtracted the 2,000? Because the expected residual value is $2,000. Salvage value, $2,000. And that is going to give us depreciation in this year of $1,333. We're going to debit depreciation expense, credit accumulated depreciation, $1,333, $1,333. Yes? Sounds good? You gonna remember that? Residual values mean salvage values with regard to depreciation. Keep that in your brains.
So it's for the lease term, not the life, because there's no
Bargain purchase option.
or transfer.
Transfer of ownership. All right, now we'll do the same date from the lessor's perspective. From the lessor's perspective, they're going to be receiving cash of $1,751. They're going to have interest revenue of $660, and they're going to reduce the lease receivable. I don't remember that was 1091. So same journal entry, just obviously, same numbers as the previous one, but now from the lessor's perspective, it's going to look like that. Do they have to record depreciation?
No.
No, they took the asset off their books, there's nothing to depreciate. Don't have to worry about it. Whoever has the asset on their books has to depreciate the asset. Whoever doesn't depreciate the asset. All right, we're going to come back to this here in just a second. This will be your first taste of what happens at the end. Well, second taste, I guess we did it one other time last time. Another taste of what happens at the end of the lease term. Let's fill out this amortization table first, so we can see what it looks like. You're going to notice it looks very similar to what the bargain purchase option one looks like. So here we have 1,111. We start with $10,000. We make our first payment on that first day of $1,751. No interest, so we decrease the balance by that amount, and we get 8,249, just like we had on the previous page. 12/31/11. We make our payment we just recorded right up there. Our interest expense is 660, our interest revenue. 1091 is our decrease in the balance, and we get 7158. And I'll fill in most of the rest of these except for the last one, and then we'll talk about that. So one thing I'll point out is that on the exam, you never fill out a table like this. This is just really to get you thinking about what's going to be happening on these. Occasionally students have tried to create tables on the exam to help them think through it, and if that helps you think, fine, just don't waste all your time doing it. You're going to run out of time on the exam. So in other words, only do that as a last ditch thing. If you can't figure out how to do it, then maybe, when you've done everything else, then go and try to make a table and see if it helps you. Otherwise, this is just here to help you think about it as we work through these problems. I've gotten an email about the bond problem.
Excellent.
Wait, I got two. I've now received two emails. All right, so these are all of our normal payments. We have 6 of them, just like we figured out at the beginning. And then on 12/31/16, which is the end of the lease term, do we have an additional payment of $1,751? No. We've made all of those payments. So what happens on this day is the guaranteed residual value. One of 3 things are gonna happen. Either the asset is still worth at least $2,000, something more than $2,000 is fine, and we give it back.